Today's show is going to be all about cash. It's been a little while since we've covered cash on the show, and with interest rates bouncing around on us, the yield curve is inverted. We talked about that a couple weeks ago. The options for storing your cash and commanding the best yield that you can in a safe, hopefully FDIC covered environment have simply changed a little bit. And so in today's episode, I'd like to talk a little bit about the methodology that I think makes the most sense for how much cash you need. So of your assets, if you have cash in the bank, what's an appropriate amount? What's too much cash? What's not enough cash? How do you figure all this out? And once you do you have your cash in the right account? That's the idea. We want to make sure we have enough cash sitting around for a rainy day before we do other stuff with it. You don't want to take, all your savings account and go pick up another rental property and draw your cash all the way down. It's a little bit too risky. This doesn't mean that you can't dip into the emergency fund temporarily for purchases or other things. It's there for a reason, but we don't want to use that cash frivolously right now. Ally, and I just looked this up to prepare for the podcast today, is paying 3.3% in a high yield savings account. Okay, there's no fees. There's a limit to 5 transactions per month, but like we talked about, that's okay. You probably don't need to access your emergency fund frequently enough for that to be an issue, right? And if you do, just bring it all back into checking and forego a month's worth of interest. It's not that big of a deal. Capital One is another option. And typically when I look at this stuff, Capital One and Ally are the two leaders because they have, again, lower operating costs. They're able to pass through more of these savings rates to account holders, and they really compete neck and neck. It's rare that I'll see a better rate at one bank than another that stays that way for more than a week. If one of them moves, the next one will move right there with them. Ladder them out. Maybe if you have, simple example, a 3-month emergency fund, which again for business owners is not quite enough, but let's use it as an example. Maybe you keep a third of that in a savings account readily available to you. You take another third and buy a 30-day CD, and then you take the remaining third and buy a 60-day CD. It's called laddering them out. That way, if business cash dries up for whatever reason, you have the first month's of living expenses in the bank ready for you to pull out whenever you need it. The second month's living expenses will mature in the CD after the first month's available cash has been depleted. And then after the second month has been depleted, the second CD, the third month's worth of cash matures and becomes available to you. That's also buy T-bills directly from the federal government. You can do that through a brokerage account. You may even be able to do that through Federal Direct, which is where you buy I-bonds, but you can definitely do it through a brokerage account. And right now, 90-day T-bills are paying 4.35%. So if you're really trying to maximize your savings rate on cash, and you're absolutely sure that you can lock that up for 90 days, lock the cash up for 90 days, that's probably the best way to go. You stick the cash in a brokerage account, you buy a 90-day T-bill. T-bills there are a lot of them out there on the market. Any major broker can help you buy one. It probably has inventory to sell you one, but it is definitely different than buying a stock. So this strategy here is not for the layperson. It's for someone comfortable transacting and is okay with the nuance here. But if you